For the first time since the 1951 Treasury-Fed Accord, the Federal Reserve is sending $0 to the US Treasury. For decades, the Fed transferred billions in residual profits, acting as a reliable revenue source. But today, that flow has reversed. The Fed is now accumulating a deferred asset, a polite accounting term for an IOU from the Treasury, that has already surpassed $100 billion. This isn't a minor accounting quirk. It's a fundamental break in the modern financial plumbing. To understand why this is happening, we have to look past the common myths and focus on the real mechanical relationships that govern our economy, which is the entire mission here at Finance Saga. The prevailing narrative of the Fed as a secretive, privately owned cartel misses the real story. This isn't about 1913, it's about 2025, and whether a 70-year-old agreement that ensures the Fed's independence is about to collapse under the weight of unprecedented government debt. To grasp what's at stake, we need a clear mechanism map, a model we'll return to. Picture a simple, three-box flowchart. On the far left, you have the US Treasury, which needs to borrow money to fund the government. On the far right, you have the commercial banks and the wider economy, which use this money and hold the resulting assets. In the middle sits the Federal Reserve, the intermediary that controls the entire process. The arrows connecting them are what matter. The Treasury sends bond issuances to the market. The Fed then uses open market operations, buying those bonds, to inject money, or interest on reserves, IOR, to control the price of that money. And for decades, one critical arrow flowed from the Fed back to the Treasury, labeled remittances. This arrow represented the billions in profits the Fed sent back to the taxpayer. Today, that arrow is broken. Let us dismantle the biggest distraction first. The idea that the Fed is owned by private banks. While it's true that national commercial banks must purchase in stock, in their regional Federal Reserve Bank, this is not ownership in any meaningful sense. They cannot sell this stock, they cannot vote to liquidate the Fed, and their dividend is not a profit share. By law, that dividend is capped at 6% or the 10-year Treasury yield, whichever is lower, paid on a relatively small capital base. This isn't a vast wealth extraction scheme, it's a legacy quirk of its 1913 design. The real mechanism for cash flow is far more important. For most of its modern history, the Fed operated as a massive, accidental profit center for the government. It bought Treasury bonds, and those bonds paid interest. The Fed used this interest income to pay its operating expenses and that small, fixed dividend to its member banks. Everything left over, the vast majority, often tens of billions of dollars a year, was sent straight back to the US Treasury. This is what's known as the Fed's remittances. In 2021 alone, this residual profit sent to the Treasury totaled over $100 billion. It was a smooth, reliable system. The Fed monetized government debt, collected the interest, and then handed that interest right back to the government it came from, minus operating costs. But this profitable arrangement, which ran for decades, just slammed into reverse. How can an entity that creates money suddenly start losing over $100 billion of it? The answer lies in the aggressive rate hikes that began in 2022. The Fed's income is based on the interest from bonds it bought years ago, many of which have very low, near zero yields. Its primary expense, however, is the interest on reserves, IOR. It pays to commercial banks, and that rate is set to the current high Fed funds rate. Suddenly, the Fed's expenses, paying 5% interest to banks, are vastly higher than its income, earning 1 to 2% on old bonds. It's now operating at a massive loss. But the Federal Reserve cannot go bankrupt, and it doesn't call Congress to ask for a bailout. Instead, it has a unique accounting privilege. It simply creates a new line item on its balance sheet called a deferred asset. This is in effect a negative remittance. It's an IOU that the Fed is holding against the Treasury, which essentially says, "We will pay ourselves back with your future profits, if any profits ever return." This deferred asset is the quantifiable evidence that the old relationship is broken. It signifies that the Fed's balance sheet is now a net drain on the government's finances. At the exact same moment, the government needs to borrow more money than ever in its history. This is the first time this mechanism has been tested at scale, and it puts the Fed's entire mandate in question. It forces a choice between controlling inflation and funding the government. To understand how precarious this situation is, we have to go back to the last time the Fed was chained to the Treasury, a period of high inflation and forced financing during World War II. That period of forced financing began in 1942 as the United States entered World War II. The government's borrowing needs were astronomical, and the Treasury demanded one thing from the Federal Reserve: cheap, stable funding. The Fed complied, agreeing to peg the interest rate on long-term Treasury bonds at 2.5%. This mechanism, known as the peg, was a complete surrender of monetary independence. It meant that if the market didn't want to buy the government's bonds at that low rate, the Federal Reserve had to step in and buy the rest. It became the buyer of last resort, forced to print money, expanding its balance sheet at the Treasury's command. This was the literal definition of monetizing the debt. While this policy successfully funded the war, it created a massive, repressed inflationary pressure. When wartime price controls were lifted, that pressure exploded. By 1947, inflation was running near 20%. Yet even after the war, the Treasury Department insisted on keeping the 2.5% peg. Treasury Secretary John Snyder argued it was essential to keep borrowing costs low for the post-war recovery. But the Fed, now led by Chairman Thomas McCabe, saw the disastrous inflationary consequences. This created an open conflict between the two institutions. The Fed was legally obligated to maintain the peg, forcing it to pump money into an already overheating economy, which only fanned the flames of inflation. The situation became untenable. This conflict culminated in the 1951 Treasury-Fed Accord. This accord was, in effect, a monetary divorce. It was a formal agreement that the Federal Reserve would no longer be required to maintain the government's borrowing costs at a fixed level. The Fed was finally freed from its chains, regaining the independence to pursue its own policy mandate, namely price stability. This 1951 agreement is the entire foundation of the modern, independent Fed. It is the single most important event in its 20th century history, far more significant than its 1913 creation. This new independence, however, wasn't truly tested for almost 3 decades. Through the 1960s and 70s, the Fed often succumbed to political pressure, a behavior now known as fiscal dominance. It kept rates too low for too long, partly to accommodate the fiscal spending of the Vietnam War and the Great Society programs. The result was the Great Inflation, a disastrous decade-long inflationary spiral. The 1951 Accord was just a piece of paper if the Fed didn't have the political will to use it. That all changed in 1979 with the appointment of Paul Volcker. It intentionally triggered a deep, painful recession. Unemployment soared past 10%. Farmers, builders, and manufacturers sent coffins to the Fed's headquarters in protest. The political pressure from Congress and the White House to reverse course was immense. But Volcker held the line. He proved, for the first time, that the 1951 Accord was real. He demonstrated that the Fed was willing to impose immense short-term pain on the American people and defy the government's fiscal interests to achieve its long-term mandate of price stability. The Volcker Shock was the ultimate proof of the 1951 divorce. It created the 40-year-long era of Fed credibility that we have all lived through. An era that allowed inflation to fade from public consciousness. But that 1951 Accord and the 1980 Volcker Shock established the Fed's power in the US. What would an economy look like if that divorce had never happened? What if a central bank remained permanently chained to its treasury just as the Fed was during the 1940s peg?
To see what happens when that divorce never occurs, we only need to look at Japan. The Bank of Japan is the modern world's clearest counterexample to the 1951 Treasury-Fed Accord. It is the living embodiment of the 1940s peg. For decades, the BOJ has been engaged in a policy known as yield curve control, or YCC, This is an explicit promise to buy unlimited quantities of Japanese government bonds, or JGBs, to pin their interest rate below a certain target. This is the very definition of fiscal dominance. The Japanese government can issue debt, and the central bank must print the yen to buy it, ensuring borrowing costs never rise. This policy has had profound consequences. The Bank of Japan's balance sheet is now an astonishing 120% of the entire nation's GDP. For comparison, the Fed's balance sheet, even after massive quantitative easing, is closer to 30%. The BOJ has so thoroughly dominated its own bond market that it now owns over 50% of all outstanding government bonds. It is the market. This policy has successfully financed the Japanese government's deficits, but at a staggering cost: the total collapse of its currency. The BOJ has made an implicit choice. It will sacrifice the yen to save the government's balance sheet. This is the 1942 peg, not as a temporary wartime measure, but as a permanent chronic feature of the economy. Let's revisit our mechanism map to see this contrast. In the United States model, built on the 1951 Accord, the central box, the Federal Reserve, is supposed to be independent. It controls the arrows for interest on reserves and quantitative easing based on its own inflation and employment mandate, often in direct conflict with the US Treasury's short-term funding needs. The Volcker Shock was the ultimate proof of this independence. In the Japanese model, the central box, the Bank of Japan, is subservient. The arrow from the Japanese government bond issuance commands the BOJ's actions. The BOJ's arrow of unlimited bond buying YCC is a reaction to maintain the peg, not an independent policy choice. The macro outcome is a one-way flow of liquidity that benefits the government's solvency at the direct expense of the currency's purchasing power. This is the crucial distinction. Is the central bank a master of monetary policy or a servant of fiscal policy? The 1951 Accord was America's declaration that its Fed would be a master. Today, that mastery is being tested by three specific signals. The first signal is the one we opened with, the Fed's deferred asset. This $100 billion plus IOU is the direct, quantifiable symptom of the Fed's internal policy conflict. To fight inflation, the Fed hiked rates following the Volcker playbook, but its balance sheet, bloated from decades of QE, is now a massive fiscal liability. Its income from low-yield bonds is far lower than its expenses from high-yield reserves. This deferred asset is the accounting record of that loss. It's the first crack in the 1951 Accord, showing that the Fed's monetary and fiscal functions are now at war. The second signal is the drain in the Reverse Repurchase Agreement Facility, or RRP. This facility is a parking lot at the Fed, where money market funds have been stashing excess cash. Earning the Fed's high interest rate at its peak, this facility held over $2.5 trillion. That number has been collapsing and is now below $400 billion. This is not a technical abstraction. It's the sound of the economy's liquidity buffer being vacuumed out. As the Treasury issues trillions in new debt, banks and money funds are pulling their cash out of the RRP to buy that new debt. When this pool of money runs dry, which it is on track to do, that easy source of funding for the deficit is gone. The Treasury will then have to find new buyers in a market that no longer has a $2.5 trillion cushion of excess cash. This leads to the third and most important signal, the 10-year term premium. The term premium is a simple but powerful concept. It is the extra yield investors demand to accept the risk of holding a long-term bond. Like the 10-year Treasury, instead of just rolling over short-term bills, for most of the past decade, this premium was negative. Investors were so desperate for the safety of US debt that they would pay a fee in the form of lower yield just to hold it. That era is over. The term premium has turned sharply positive and, more importantly, volatile. A rising term premium is the market's way of expressing doubt. It is investors, in real time, demanding more compensation because they are worried about future inflation, political instability, and most critically, the risk that the US is simply issuing too much debt for the market to absorb. This is the market's fiscal dominance warning light. These three signals, the Fed's internal losses, the RRP liquidity drain, and the market's rising term premium are not independent events. They are all pointing to the same critical vulnerability. The RRP drain is the countdown clock, and the term premium is the pressure gauge. This combination sets up a quantifiable collision course, forcing a choice between the 1951 Accord and the 1942 Pega choice that will define the next decade of American finance.
This collision course is no longer theoretical. It can be quantified with a clear if-then funnel, a set of measurable thresholds that define the breaking point. The base case, which financial markets have operated under for 40 years, is that the 1951 Accord will always hold. But if we are entering a new regime, the data must show it. Here is the critical sequence to watch. If the reverse repurchase agreement facility, that $2.5 trillion pool of excess liquidity, continues its drain and falls below its historical floor, let's use $200 billion as the threshold, that emergency cash buffer is effectively gone. And if, at the same time, the 10-year term premium rises and stays elevated above 75 basis points, or 0.75%, for 4 consecutive weeks, that is the market signaling a full-blown buyer's strike. This combination would mean the Treasury has no easy cash cushion left, and that the private market is rejecting its debt. At that point, the Fed is trapped. Its hand will be forced. But barring those outcomes, the choice remains, and it represents a clear fork in the road, with two very different sets of winners and losers. Let's trace the cash flow for each path. In Path A, the Fed honors the 1951 Accord, just as Paul Volcker did. It refuses to buy the government's debt and continues to prioritize its inflation mandate. It keeps interest rates high, or even raises them to attract private buyers for all the new bonds. Who pays? The government, first and foremost. Interest expense on the national debt would explode, forcing a genuine fiscal crisis and likely massive non-negotiable cuts to government spending. This is the path of immediate, acute, and politically brutal pain. In Path B, the Fed's independence breaks and fiscal dominance wins. This is the 1942 peg, or the modern Bank of Japan model. When the market won't absorb the debt at a low rate, the Fed steps in and buys it. It pivots not because inflation is defeated, but because the Treasury's funding mechanism has failed. It would announce a new round of quantitative easing, or perhaps even explicit yield curve control. Who pays? The answer is every single person holding US dollars. This path means the Fed is actively choosing to finance the government by creating money, which is the classic textbook definition of inflation. The primary payers are savers, who would see their cash taxed by an inflation rate that the Fed is now complicit in. Anyone on a fixed income would be devastated. Who benefits? The government, which gets its funding secured at an artificially cheap price. Debtors, who get to inflate away the real value of their mortgages and corporate loans. The popular conspiratorial view obsesses over the Fed's private ownership, a relic of 1913. The real story, the one that matters right now, is about the arrows. The 1951 Accord was a declaration that the Fed, not the Treasury, controls the arrows for interest rates and bond purchases. The Volcker Shock was the proof, but the $100 billion deferred asset is the first crack in that proof.